So I call this the market of the moment, right? Because, the real estate market changes all the time. So, we went from, super nuts seller's market, 30 offers to can't buy a showing, and quite, almost overnight. So, and then, and either one are fun, right? I mean, if you're a listing agent with, you're receiving 30 offers, I mean, you're getting accused of not presenting them and, all that kind of stuff. And of course, if you're the buyer's agent, you got a buyer that's being priced out every time. I mean, that's very frustrating to where now you have sellers that have to sell and, and that's the way it is. So let's get going. So the things we're going to discuss this morning are inflation, prices plus or minus. We're going to talk about interest rates and then buy downs. So we'll talk about how they all play into today's market of the moment. So first thing, so I want to show you the correlation between the inflation, the 10-year treasury note, and interest rates, because it's really important to understand that the Fed rate is not the mortgage rate. That mortgage interest is tied more to the 10-year treasury note because because the Fed rate is an overnight loan, which is very short term. And so where mortgages are very long term, even though they may be a 30-year mortgage, probably 6 or 7 years on average. And so when you have the Fed rate being very short term, so when the Fed raises their rate, that is, short-term rate. So that controls like car loans, credit cards and things like that, and overnight loans between banks and, the what do they call it? The treasury thing. I forget, but anyway, you all heard the name. It's the central bank, the name for the central bank. So and then so here's the correlation, right? So in purple you have the inflation, and in orange you have the 10-year treasury, and blue you have 30-year mortgage rates. So you could see that they follow each other. Now it's not an exact real time and it's not lockstep, but they follow each other all the time. And then you can see where we're kind of at, up top is where inflation kind of was. And then, but rates didn't go up. I mean, they kind of did, but I'll share with you how that worked. So, but I just wanted you to see the correlation of what really kind of drives rates. The 10-year treasury and inflation drives, causes treasuries and whatnot to move up and down, and then mortgages are tied to that. So where inflation goes, rates go. Inflation goes up, rates go up. Inflation goes down, rates go down. And inflation is coming down, and it's not going to be a straight line. It's not going to be pretty. It's just, but eventually rates are going to come down, and we'll talk more about that. So here's a chart that shows you the CPI, which is inflation, and then you got the 30-year fixed rate, right? And so they both were humming along real low, and there's and then all of a sudden the inflation started to take off. Now normally rates follow. The problem we had there, if you could see this line here, because here was the this was a recession, okay, and this was, we had a recession right before COVID, and then you had all the government stimulus, you had the government quantitative easing, that's what this was called. So the government came in and they did quantitative easing, and then typically rates go down during in a recession anyway. But this recession was kind of very short-lived because of what happened with the government shutdowns and then what the government was doing. When they shut down the economy, they have to give money. I mean, they can't just like say, sucks to be you. So this period here is what was called quantitative easing. And what that is that was the government buying the 10-year treasury bonds. So because they were buying bonds and they were buying them in large scales, they were keeping rates down. And so because when inflation started to take off a little bit, the government said, well, it's not going to last long, so we're going to continue what we've been doing. Well, because they kept continuing and rates kept staying low and low and low, as inflation was taking off, they kind of missed the mark a little bit. And then, that just caused inflation to exacerbate and go more because money was cheap. So what the government likes to do during inflation periods is raise the Fed rate which causes, the cost of money to go up. Like your credit cards and, consumer spending, the cost of consumer spending goes up and they try to slow it down to bring inflation down. That's what they're doing with raising rates. So eventually they said, okay, we have to stop with the quantitative easing. And as soon as they did, boom, interest rates took off. They followed inflation. You could see inflation come down a little bit. That happened like in November or whatever, something around there. And then, and I'll show you the chart of how inflation gets measured. And as soon as it did, rates started falling below. So you can, I just want you to see that, how that works. That's the way, how things follow along. So anyway, and if you have any questions, just, unmute yourself and just, go ahead. I mean, you can unmute yourself as long as you don't have a lot of noise in the background. And so anyway, so the next slide is, market of the moment. So let's look at how inflation is calculated. So that's kind of a, this will help you understand how the rates are moving. So the next slide, here it is. So the way they calculate inflation is each month there's a CPI number. And so, and then what they do is they add up the 12 numbers, the 12 months, and they give you the annual, right? That's your year of inflation. So when they said inflation was 8.5, that meant they were adding up all these, 12 months of these numbers. Then there's the CPI, and then I think it's the other one's called PPE. So one of them doesn't include housing and food, which, it's kind of like, because they're obviously not discretionary. So, but housing is high, even rentals, and we'll talk a little more about that. So what they did, so as you can see, so the numbers were high, right? So each month, where we're at. So we're up here now, right? So this was the year, I mean, March was low, just had one of those, July was low. So what happened is in January was low, so the year before, so let's look at June. So June was 0.8, and then last June was 0.7. Then you could see as September or October was 6, and then October here was 3. So, but because of that, because that was like your first big spike after, a couple high months, then when the October reading comes out in November. So November 10th, they announced the rate, that inflation was coming down and rates came down. So there was a really good improvement on rates. And so then, the next month, December, a little higher than November, but significantly, so it's still half of what it was the December before. So this is how inflation numbers are added. Now, as you look, so January was high, it was 0.6. So in February, so I think it's February 14th is when the January numbers will come out. So we should see an improvement again. And then March, we're probably not going to see an improvement. And then, but in April and in May again. So, so probably around May 10th, and that's the people that I follow and study from it, which is right here called MBS Highway. So MBS stands for mortgage-backed securities. So these are securities and bonds that are, is the money that you borrow when you're borrowing money for a home. So May 10th, May 10th will be the big announcement. So May 10th, we should see all these numbers here coming down and seeing a lot better. So May 10th, we should start seeing really good improvements. Now, let me give you a caveat. Now, that's barring what they call black swans. So if you're not familiar with what a black swan is, so a black swan is just an unforeseen situation or circumstance. World War III breaks out, all bets are off. Because that changes the way everything happens. So does that make sense? Anybody have any questions so far? Not, we'll move on. So the other thing to understand is there's two main areas of mortgage loan. There's originating and servicing. So I'm an originator. So we originate the loan and we sell it in the secondary market. Fannie Mae, Freddie Mac, Ginnie Mae, and that kind of stuff. So when we sell our loans, so those organizations that buy the loans in the secondary market, they don't service loans. So servicing is whole nother animal. I mean, think about it, you have, $10 billion of loans. And so somebody has to collect a payment every month, disperse the money to whomever. They, monitor the escrow accounts, send out the monthly statements, send out late notices, everything that goes along with servicing and collecting money on a mortgage. So those are companies that do that. And so what they do is they buy servicing rights off of the originators. I'm not the originators, the secondary market. Those that originate. So we originate and sell it to the secondary. So the secondary market, they sell what they call the servicing rights. So what they do, and then the servicers, they charge a little bit of money every month. So they make money, but the only way they make money, the only way the model's profitable is if they collect the loans, for at least a couple of years, and they really want to hold on to them for 6 or 7 years. That's how the servicers make their money. So they pay a certain amount for it, and then they have to collect for a certain period of time. So does that make sense? Any thoughts on that right there? Because that's an important thing. Our next slide, our next graph is going to show you an interesting thing that's happening. So the longer the loan is likely to last, the more valuable the servicing rights are. And so that's the key right there. The longer, the likelihood of the loan lasting 5 years, 6, 7 years, the more valuable the servicing rights are. If the servicers know that that loan isn't going to last long, then the value of the servicing rights goes way down. And so now let's look at the next chart. So as you can see, this is a 35-year history, right? So the yellow is the 30-year fixed mortgage, and then the blue is the 10-year treasury. So traditionally, and again, not lockstep, not in real time, there's always about a 175 to 200 basis point spread between the two. Now there's differences when they shift and move, but they settle in. And so 175 to 200 equals 1.75 to 2%. So normally that's normal. So all along, there's always that spread. Well, at the end of last year, the spread jumped to 300 basis points. And the reason for that is because the servicers know that because rates are high, they know rates are coming down. They know they're following the same thing. I mean, you think about it. If I understand this, the actuaries of these big companies that are, buying 10, 15, 20 billion dollar lots of loans, they have actuaries that study this at levels that I couldn't even fathom. So if I understand it, they do. So they know rates are coming down. So what has to happen is the banks have to charge more money so that because of the way the servicing rights work. So the servicers have to make they're charging points, or the loans cost more money today. It's not just the rate is higher, but the actual loan costs more money. So so they have to charge more upfront to make the servicing element profitable. Because without servicing, I mean, you can't get a loan. So it's very, very critical. So everybody follow me so far? I hope so. If not, just unmute yourself and ask the question. So this is kind of where we're at now. So right now, though, it's actually come down to about, instead of 300, it's about 270 basis points. So as this starts to come down, right, as rates come down and, inflation comes down, and then we're actually heading into a recession, which recession, and let's get real clear. When you hear the word recession, do not think 2008. Excuse me. So 2008 was an anomaly, or I shouldn't say an anomaly. It was the right reaction to what happened, but that's not your normal recession. That was a financial crisis that drug the whole nation into a recession, which crippled the housing market. So that's not your normal recession. So, and housing is already in a recession. So by the definition of 2 quarters of downward numbers. So we have that. So we already have a recession in housing. And some economists are speculating that this is going to be what they call a rolling recession. So a rolling recession is where different segments of the economy go in and out of the recession. So the whole country's not in a recession at the same time. So technology's starting to lay off people. Housing's already in a recession, but it's not going to be as bad. It's not going to be anything like we had in 2008. Because see, once housing got crippled by the financial crisis, that just, it just spiraled down. It just drug everything down. So let's look at why the difference between, let's see what my next slide is. No, I don't have the slides for this, but excuse me. So housing, we still have a shortage of housing. I believe I have a slide in there for that. Hold on a second. So smart money is saying rates will be down around 5.5 plus or minus, maybe around 5, around Q2, Q3. Another indicator is banks charge points. Why? We talked about that. So what is going to happen? So think about this. Unmute yourself and tell me what you think. If rates hit 5.5 or 5, what's going to happen? Let's unmute yourself, guys, and join in.
I think more people will come out of the woodworks to buy houses.
Yep, and so you're going to have a surge of buyers coming into market, right? What will that do?
Make things more competitive again.
Yep, things are going to be competitive, and it's going to put pressure on price, right? So that's what's going to happen. So because right now, right, you can get prices will either hold strong or go up. There will be competition, meaning your FHA or your low down conventional buyers will have a hard time competing again. That's important to understand. That's a critical element right now. So your FHA low down conventional type buyers, they can go in the market right now and buy a house. Now the rates are higher, but they're going to come down. So let's just, but understand that that type of buyer, when the rates come down, they're going to be struggling to be able to buy a house again. So there'll be an upward pressure on price. The first thing that will go is concessions, right? They won't be automatic. Like right now, you can go in and like with some of these builders, you can go in and get closing costs and buy downs. We'll talk about how the buy down works. So, but I mean, so imagine that. So imagine going in and getting a buy down, rates dropping into permanent financing, and we'll talk about how that all works. Excuse me. So anyway, so let's move on. So my opinion is now is the time for these buyers that had a struggle last year. Now's their shining moment. This is their turn to get a house. I mean, we're already starting to see traffic pick up. You can hear it in the rumblings in Wasatch Front Agents Facebook group. The showings are starting to increase. So right now competition is low. Sellers are soft, right? That's the market we're in right now. Now, really good, well-priced properties are still getting multiple offers. I helped an agent through, she was one of 6 offers on a property. She said she looked at the property, it was listed for $675. She said she would have listed it at $710. And so they aggressively priced it. Boom, it wound up selling for $720 in a couple days with multiple offers. So even in this climate, you're still getting that kind. If you're priced, because see, you can't price too low. If you're on the listing side, don't worry about pricing too low because the competition will just drive it right back up. And the truth is, if you price it low, that's how you sell a property fast for more money. So even though pricing it low seems like counterintuitive, but you're actually going to net more money by doing that than if you priced it at $710, $720. It may have sat on the market for a while. Then what happens is 30, 45 days go by. Then you wind up dropping the price. Then the buyers are like, well, there's something wrong. So let's offer them $690, where they did it the right way. $675, bang, drove the price right up to $720.
Hey, Rob, do you know where that home was?
It was in South Jordan somewhere.
Okay.
Daybreak. It was in Daybreak.
Oh, gotcha. Perfect. Thank you.
So prices are they going to fall? So I don't think so. Now there may be pockets, right? Because real estate's local in nature. Real estate's like the weather, right? I mean, there's no like today's temperature in the US 68. That doesn't work. you got 12 in Anchorage and, 82 in Key West. Real estate and weather are local in nature. So you may have some pockets, if you have areas where they, maybe losing a really big sector of jobs, that could cause prices to come down because, so rates help prices. But it's really interesting. Rates went up, skyrocketed in a very short period of time, and prices are sticking. Now, there are, like I said, some spots have come down some. Now, a lot of the price adjustments you're seeing are not really prices coming down. If you can visualize prices going straight up and then see another graph where sellers, the line for sellers going straight on a upward right angle, and then visualize another line where it starts to taper off a little bit, where prices aren't going up as fast. And so that's what happened in the market. The prices weren't going up as fast, but the sellers never got the memo and they kept going up and up and up. So because they kept going up faster than prices were actually going up, they had to adjust back down. So really weren't seeing a real like prices coming down. I just think you had enthusiastic sellers and listing agents. So that's my opinion on that. So are they going to fall? I don't think they will. So let's next chart. So why do prices fall? Unemployment is too high. People lose their jobs, right? Equity or the lack thereof, right? If you don't have equity in your home, and people, it's like you don't protect it as much. If you have to sell it, you're like, heck with it, I'll lose it. Supply and demand, too much inventory. So now let's look at that. We know that's why prices come down. So unemployment, Utah's unemployment rate is 2%. If we doubled or tripled, we'd still be okay. Now, it wouldn't be great for everybody, but it wouldn't crash the market. I mean, if we went to 4%, we'd still be just fine, housing wise. And so equity, there's more equity today than in the history of Earth. So in 2008, because we had too much demand, and I got the chart to show you that. So the next one is supply and demand. So we'd have to have more sellers than buyers. And so we know that's not true. Let's look at the charts. So the inventory, this is existing home inventory, right? So this area here is kind of like normal, right? This is kind of normal, just between the 2 million and 2.5 million range. Well, in 06 and 07, I mean, the inventory is way up, right? I mean, it's seasonally down, so, but you see the seasonally spikes too. And this was during the boom. And then they started tightening up on the loans and, we still had a ton of inventory. Eventually it started getting absorbed. And here's where we are today. So we are well below normal levels of inventory. Again, here's normal. Around here is normal. 2 million or plus. And we're below 1.5 million. So we could actually double our inventory to be normal. So this alone tells me that we're not going to see prices fall. Now, like I said, there could be pockets, but we're not going to see it across the board. Right? Any thoughts, questions on this? Even though our inventory doubled and tripled, since like say January of this year, but that's because, our inventory was ridiculously low. We've never seen that kind of low inventory. I mean, I never did. And so, not with our population size. I mean, it may be 50, 60 years ago when populations were considerably smaller. So, excuse me. So anyway, so thoughts, questions, concerns on that? Okay. So the market of the moment, the 2-1 buy down, let's talk about that. So what is it? It's a temporary reduction in the interest rate payments. In other words, you get the effectiveness of lowering the interest rate. The interest rate is never lower, and I'll explain how that works. So the first year is 2% lower than the rate of consummation. And then the second year, it's 1% lower than the rate of consummation. The third year, it's back to the regular normal rate. So, and again, they're not lowering the rate. So what happens is It's, let's talk before that. So the cost is about 2.5%. There's variables, that's an unexact, number, but you can estimate in your mind about 2.5%. So then like right now, you're better off, in my opinion, getting the seller to give you concessions, maybe get a buy down, because I'll explain why on the buy down. Why the buy down is very good. You're not going to lose any money. So rather than lower the price for $10,000, you're better off if you have the money, just take the 10,000, the concession from the seller, and I'll explain a little more. So the $400,000 loan, it's about a $10,000 cost. So if you can get the seller to pay that, and then how it works is the buy down money. So let's say the $10,000, let's just, for simple math, there's a $10,000 buy down money. That money goes and sits in an account. Each month, the lender reaches into the account and draws the shortage. So your first year is, like I said, 2%, the payment is 2%, is based on 2% lower rate. So if you refinance in say a year, right, if there's a shortage, so what happens if we refinance before you use the money, before the end of the 2 years, right? The money will be applied to the principal. So let's say you only use $5,000, then you refinance. Well, you have $5,000 left over, so you lower the price 5,000, which means you can put the 5,000 back in to pay for your closing costs. So essentially, any money you don't use in your buy down will essentially pay for your closing costs on the refinance. So does that make sense? Any thoughts on that? So the net effect is the balance, any balance of the buy down will pay your closing costs. That's the net effect. So let's see. What are my next slides? So now what? That's the question. What do you do now? So what I'm telling agents to do is call all buyers that tried and couldn't buy during the ridiculous period, because they're waiting for rates. So they're sitting there waiting for rates to come down. And the conversation is you need to have with them is you need to call them up and say, look, if you wait for rates to go down, you're going to miss out again. You can get, because prices aren't going any lower than they are today. Again, barring no black swans. But so because when those rates come down, that'll keep pressure on prices. And the fact that we have very, very low inventory, it may seem high because of where we were to where we are, but we are still very low. So you have to get buyers on the phone now and start talking about this, because as you see rates start to move down, that's the time you got to shove them into the market. Because and it's for their own good, because if not, rates go down, surge of buyers go to market, drive prices up. At the very least, concessions are going to disappear. And, then they're going to have to come back with their, if FHA, 3.5%, they can go Utah Housing, which kind of limits them on certain things, things like that. So, they're not going to be able to get help from the seller. So that's what I'm telling people. So I think if they wait, they're foolish to wait. So any thoughts, questions, concerns?
I don't know, Rob, that graph that you put with current inventory, I missed the housing forecast the other day, but that's been my gut on the thing, is that there's just lower inventory. And I think what sellers are doing is just, not selling, they'll just rent instead. And so I think with that inventory low, I don't think prices are really going to go down that low.
No.
And I don't know, it's right now I work with a lot of first-time home buyers. People can't currently afford,
right?
Seemingly. Some can, obviously, but a lot of them just can't. And so I think they're holding out for prices to go down, which doesn't seem like it's going to be happening.
No.
It seems hopeless to me, Rob.
It's not hopeless.
Just because then if interest rates go down, there's going to be more buyers, and
right.
Are sellers still going to be satisfied with the prices they're getting enough to actually put their houses on the market? I feel like it's a little circular.
Yeah, there's always going to be that the effect of those with that are married to their 3% mortgage. You know, it's hard.
Yeah, that
hard to,
too,
like-
like, it's hard to
it's
get rid of that.
Yeah, it's hard to increase your, because, you know, they may have a $500,000 house, but they only pay 275. So they have a 275 mortgage at 3%. In order to step up into a nicer house, they have to go to 650. You know, and then 650 with a mortgage that's considerably higher. So that's kind of the problem.
No, exactly.
With
That's
the
why
sellers.
you know, most of the, I realize this is a class on how to talk to your buyers.
That's okay.
And, you know, from that perspective, it's like, okay, sure, you know, if rates go down, things get more competitive. I always use the term, you know, pick your poison. Do you want to be in a market with low interest rates and lots of competition, or would you rather pay
Right.
a little bit more and have less competition, get your closing costs, your buy downs, et cetera? Like, that seems fairly obvious, but it only works if they can afford it, which a lot of people just cannot. I mean,
Correct.
and so from a seller's perspective, I think maybe your next class should be how to talk to your sellers, because yeah, it's hard to, even myself, I go, I don't want to get rid of this place because, you know, I'm paying
No.
2.875. Like, why would I?
Right. Right. I got a
So
order. You know,
yeah, yeah, good for
on a
you.
VA, no mortgage insurance, nothing. You know.
Yeah, yeah.
Yeah, I'll never sell this. I shouldn't say never, but I'll rent it before I sell it.
Yeah, I think we're just in a market where it's like, if people absolutely have to sell, like, obviously we're always going to be in business because there's always going to be marriages and divorces and deaths and births and things.
Right.
People are going to have to do that. But,
Job transfers and blah,
you
blah, blah.
know, talking to people from an investment standpoint is a little trickier right now.
Right. Yeah, investors, it's not a good market for investors if they're leveraging. I mean, if you have cash, it's not a big deal. But it's still, because from an investor, if you're borrowing money, the cap rate has to be 2 points higher than the cost of money. And right now, investor loans are, you know, they're in the high 7s, low 8s. So that means cap rates have to be 10. And, you know, I haven't seen a 10% cap rating. I don't remember the last time, not in Utah anyway.
Yeah, I've definitely
So-
never seen those numbers.
Yeah, exactly. So, you know, so anyway, it's here we are. It's the market of the moment. You know, and if so now is the time. Excuse me. So, you know, if you're working with these younger buyers, and you know, I'm more than happy to get on the phone and do this presentation and walk them through it. You know, I mean, if you had the conversation, you know, if you can start priming a pump and you need me to, you know, to get it going, let me know. I'll literally do the presentation. In fact, I'm putting together a first-time home buyer or a home buyer seminar. Doesn't have to be first time. And we're going to do it online. And so because we're going to do it online, I can have multiple agents at one time. So, you know, let's say the 4 of you that are on this call, you know, you guys all drive traffic. I'll have a registration page for each one of you, let's say. You know, let's say the 4 of you do. So each one of you have your own registration page. So when you market it, the register, and then someone registers on your page, you know, we know who they are. So they attend the webinar. Excuse me. And then, you know, I'm going to go through some of this. You know, I don't want to get too deep in the weeds because, you know, we want to cover a lot of area. And then, but the idea is, if you need me to talk to them, I am more than happy, because I have the heart of a teacher. You all know that. That's why you're here. And so a lot of your younger buyers, they need education, and, you know, I just take them under my wing and they appreciate it. So anyway, that's my pitch for me. So thoughts, questions, concerns, hallucinations? No?
I think everyone's good. Thanks, Rob.
Yeah, no, my absolute pleasure. If you have any questions at all, feel free to reach out. You guys know how to, if you can't find me, you're not looking. So,
Thank you,
anyway,
Rob.
okay.
Great material.
Sorry?
Thank you, we're good.
Of course. Of course.